Welcome back to the Finance Corner. My name is Malik and I am your host with the most. So, this video is basically going to be the first starting video in a series where we're going to take a lump sum of money and we're going to try to flip it slowly, but using options contracts, specifically the wheel strategy. So, we already made our first trade and let's go right into it and explain what's going on. So here we have our Robinhood account. So what I did was I'm going to start with $7,500 and we're only going to be selling options until we flip it or at the bare minimum at least get it to 10,000. Make like 2,500 profit. But ideally we're going to go ahead and try to flip it using only selling options. So if you don't know how options work, basically they're contracts for the underlying stock. You can have options on other assets as well, but people usually use them on stock. And the way it works is each contract is worth 100 shares of the underlying stock. And then there's these other factors that depends on, or that really gauges how sensitive the option price is to other factors. They're called the Greeks. And essentially, these Greeks kind of determine what the price of the contract is going to be. And you have buyers and then you have sellers. So you can buy contracts or you can sell contracts. Buyers have rights, sellers have obligations. So just a quick, options overview. When you're a buyer of options, again, you have rights, but your rights are to buy or sell the underlying stock at a particular strike price. And typically, when you're buying options, you have a much higher potential upside. For example, if a stock is trading at $10 and then you have an options contract to buy it at $5, you have a long call at strike price of $5. Well, that $10 option or that $10 underlying share price can go much higher than just $10, right? And then no matter how high it goes, you can still buy it for $5 and then capture the difference. And then it's the same thing on the downside when you're buying puts. You buy the right to sell at a particular price, but if the price goes a lot lower than that, you can actually take advantage of that spread, that difference there. So we're not going to be buying options in this account. We're really just going to be selling options, and we're going to be collecting premium. Premium is the price of the contract. So premium is what you pay for each contract. What you pay if you're buying, or premium is what you get when you're selling. So buyers have rights, sellers have obligations. You can sell or write a contract and you basically get paid for writing that contract. And this is what the foundation of the wheel strategy is about, right? You're basically going to sell a put. That's the start of the strategy. You sell a put, you collect the premium, and then hopefully you want the option to expire worthless because then you get to keep the premium and you move on to the next trade. But if it doesn't expire worthless, you basically have to remember sellers have obligations, so you're obliged to, you know, go with the terms of the contract that you wrote. So let me explain the first trade that we did on this account. So we started with $7,500, and then we actually have a Kohl's $21 put. So we sold a put on Kohl's for $21. Now, if this would just load up here, I'll show you my exact thought process. So Kohl's is a retail company that I kind of like them. Um, this I guess there's another kind of not rule, but you want to formulate a strategy when it comes to any type of investing, right? So my strategy for when it comes to trying to sell options is I only want to really sell premium or sell options on stocks that I actually don't mind owning or stocks that I actually like. So Kohl's is a stock that I've been researching for a very long time, and I'm very comfortable with what they do, how their stock moves, and all that good jazz, right? But let me explain the timing of the contract. I'd rather let me go into explaining a little bit more about Kohl's real quick, right? So it's a retailer, and they they've had a lot of recent issues with like their CEO, um, the not the current CEO, but the CEO prior to this was basically doing some like insider bullshit where he made an illegal deal with another company, and basically it was because he was having an affair, or he was a lover of like the CEO or the CFO of another company, and he made an illegal deal without actually getting board approval. He actually, that's, I don't know why you would do that. You don't mix, you don't, shit where you eat. But anyways, they fired him. I forget his name. They fired that guy, and now they had a couple CEO switches in the past like 2 years. But now the current guy is basically going to be should be doing the right thing and like getting everything back on track. They've been having issues with like losing sales for over the year, but they're kind of turning that around, and the market believes that. So let me go into explaining a little bit more about Kohl's. As you can see, here's the weekly chart. Let me go to a daily chart on Kohl's. So for a long time, Kohl's has actually been trending down. You can see we were all the way up until like $30 per share back in the end of 2023, early 24, and then all of 2024 we just kept going down, going down, going down, and then during this time, mid-April and stuff is when we were having a lot of the CEO issues, and then we actually finally got the CEO we have now around May, and you can see it actually led to a minor short squeeze. So take a look at this price action here. You see Kohl's go as low as $6 per share, $6.12, $6.20 per share, and then shortly after, it squeezed up until 231% higher to a high of like $20.54. And you can see this only happened in a matter of like a few months. So this is actually a short squeeze, but it's not to be confused with like, I think some people, when they think of short squeeze, they probably automatically think of like what happened with GameStop back in 2021. But that was like the mother of all short squeezes, like, because a short squeeze can go as high as it wants, but typically it doesn't have to be as crazy as when it did in GameStop and those other stocks like AMC back in 2021. But this is the stock price chart or the price action chart for Kohl's. You can see we had a short squeeze here, and then it came back to equilibrium, but we're still, as you can see, we're still kind of holding this uptrend here. We're still kind of holding this uptrend. Now, let me go into a little bit more of the fundamentals of the company and why I like it. So this website is called finviz.com, and here you can really get a nice summary of a lot of the ratios that these analysts use to identify or look at companies. So, we have Kohl's here, and then all of our important ratios. I'm not going to go through every single one, but you can look up, what's important to you. But some of the things that you should know is like dividend estimation. So they pay 50 cents per share in dividend, which is about 2.43% of their earnings, which is not too bad. They used to pay a higher dividend, I think like last year, but then they were running into issues with sales, and the dividend was not as sustainable as it could have been. But they paid a lot higher dividend. I forget the ratio. It was like 8% or something like that. But so their current market cap is around 2.4 billion. They have a PE of 12.05. which is pretty, not bad. If you're comparing PEs to a lot of other companies like tech companies, they go as high as like 60, 70, 100. Palantir's at like 400 PE. It's like crazy. But then you got price to sales ratio. So this means you're spending 15 cents for every sale that they make. That's price to sales ratio. Price to book ratio means you're spending 59 cents for every dollar of assets that they have on on their balance sheet. So I've looked at Kohl's balance sheet, and they have a lot of real estate and a lot of healthy assets. So again, this is a company I would not mind owning for all of these various reasons. But real quick, we've seen that on the stock chart, it had a short float or it had a short squeeze. Just pay attention to what we have going on over here. The short float is the percentage, is basically the percentage of all outstanding shares that are currently and actively being shorted in the market. So 25% of outstanding shares are being shorted by the market right now. And this is not too bad, but when we had this short squeeze back in, this was July of 2025, this metric here, the short float, was around like 50%, like very close to 50%. So again, that means 50% of outstanding shares were actively being shorted on Kohl's. You know, and we can actually see that based on the price action that we had all year. It just kept going down and going down, and it wouldn't stop going down, right? But during all of that time is when it was heavily being shorted. And again, that ratio, that short flow was around 50%, 48%. Now you can see we're not being as shorted, or the stock is not as shorted. So it's only 25% of these of outstanding shares being shorted on the market, and that's pretty sustainable. But let me go into basically the specific options that I did. So the current share price when I was looking at it was above $21. It was just above $21. So this contract I think had I wonder if they show the Greeks when I was looking at it. Yep, it has the Greeks. So it has the delta of 0.55, gamma of negative 0.17, theta 0.034, vega negative 0.01, and a rho of 0.004. Rho is not going to be that much of a factor because there aren't going to be that many interest rate changes, because there's only 2 weeks I have for this expiration date. But now my thought process, right? I wanted to collect some premium for writing this put, and based on the current share price, I didn't mind owning it at $21. Again, that's not really the goal. I don't want to get I don't want this contract to exercise on me, where then I would have to buy Kohl's at $21. But I did like the premium that it paid me. But here's the problem, or here's the mistake that I made, right? Today is January 10th, Saturday, 2026. On Friday, we were supposed to get the announcement of whether Trump's tariffs were legal or not. And that's a really big deal. That's a really big deal because it's going to have a lot of implications for the market, because one of the rulings was like, if it was deemed illegal, there's a lot of companies that would have to get refunds, and it would generally shake up kind of like how we've already established how tariffs are going to work going forward. So it's definitely going to shake up a lot of businesses, and it's going to have a huge impact on the market. So I was really expecting some volatility on Friday. Little to my knowledge that, like, I was ready to make the trade on Friday after we got that announcement, and then there was a time period where they said we weren't going to. Maybe I'll find the screenshot and put it up there, but they said we weren't going to get the decision of Trump's tariffs by the Supreme Court on Friday. And then I was like, well, damn. We aren't really going to know when we're going to get that at all. So
there was a limbo period that we didn't know. So it was like a couple minutes, like 30 minutes later to an hour after I got the news they weren't going to announce it. I said, you know what, I'm just gonna put on the trade anyway. It's not too risky, and we're just gonna put on the trade anyway. But I really should have waited because there was a couple hours later after they said they weren't gonna announce a Friday. They did give a date for when they would announce the decision of Trump's tariffs, and I believe that's going to be on Wednesday this week coming up, which should be about, I think that's like the 14th or the 15th. I don't math, but anyways, that is really when we're going to get the decision for Trump's tariffs, whether they're legal or not. That's going to be a huge implications for the market. So to be honest, if you expect volatility to be on a certain day, that's probably a good day that you can sell some options and collect a higher premium because volatility is much higher. So that plan kind of went out the window because I put on the trade anyway, but the expiration date we have this is for 2 weeks out. So we did 2 weeks out, paid $95 per contract, and it would make my break even point $20. So essentially, if we get assigned on this trade, we are going to own Kohl's at $20.05. Own 300 shares at $20.05. So you see, we sold it on Friday, and expiration date is 2 weeks out. So current, based on the current close, we didn't have a positive day because go back to the stock chart here. We actually have we actually ended on a down day. So Friday, I thought we were gonna end up a little bit higher, but we have this candle here that came up, took this last candle's high, and then it looks like it closed down here at $20.50. So now this is probably not the best trade, the best first trade for me to have, especially on the series where we're trying to double our money. But like, there's a lot of things going against me. But we'll see what happens by the expiration date. But one thing that I was also worried about is this gap here. So stock charts have gaps everywhere, but this gap looks like it was due to an earnings release, which means basically I can see price kind of coming down back into this area. Um, we don't know how long it's going to stay down there. If it's going to bounce out or whatever. We don't know what price action will look like. But just based off of my analysis and years of studying technical analysis and reading price action, I can see Kohl's kind of coming down into this range, which again is not good for my options play because we need Kohl's to stay above $21 by the time, let's mark off the 23rd. So by this Friday here, we need Kohl's to be higher than $21. So we got this week coming up and next week. So let's see how price action plays out. But hopefully we actually end up expiring worthless and we get to keep. I think we got paid 285, 285 premium is what we got paid, and yeah, 285 premium because 0.95 times 3, so around 280 premium we got paid, and yeah, that's the trade. So we have to wait 2 weeks to see what happens. Um, you know, when we get closer to expiration date, or maybe after expiration date, I'll see if I want to roll it over, or if we get some volatility, maybe I'll just close it early. But this is the first trade for this challenge or this series. So that's pretty much my thought process there. Buying or I'm selling put on Kohl's for $21 strike price 2 weeks out, and we want this contract to expire worthless so we can collect our premium and move on to the next one. And so this is the first video to the series of slowly flipping our money. So if you like this series, check me out, give me a like and a subscribe. I would really appreciate it. and I'll see you guys on the next one.